Detecting corporate failure before it manifests publicly is a critical board responsibility. While traditional analysis focuses on trailing indicators, institutional distress follows a highly structured, multi-phase trajectory. The conventional view breaks corporate decline into three distinct phases: financial latency, operational desperation, and the terminal spiral. Beneath the surface, asset-liability traps emerge. These are driven by maturity mismatches, rolling over short-term paper to fund long-term illiquid assets, and severe debt service coverage squeezes. Governance structures begin to fracture. Watch for delayed disclosure cycles, frequent strategic advisory rotations, and a silent talent drain during internal gridlock. Concurrently, subledger loops and off-balance sheet mirages mask core distress by bleeding cash from healthy entities to artificially subsidize failing units. Over my career, the most critical indicators I have analyzed are those hidden beneath standard business operations. For example, financial institutions aggressively matching or exceeding market interest rates simply to attract defensive customer deposits. In capital-intensive sectors like construction or real estate, a red flag is the rapid, aggressive acquisition of new project portfolios while legacy projects face systemic handover delays. This is often an extraction tactic to use mobilization advance payments to fund older operational deficits. Similarly, anomalous insider share volume trading clusters emerging directly adjacent to massive new project disclosures often mask short-term equity support maneuvers. We also observe the programmatic acquisition of unproductive or distressed subsidiaries, alongside the reclassification of significant non-performing balance sheet assets into opaque holding categories. A critical warning sign is the manipulation of related party transactions. Hard cash is aggressively stripped out of the core company through unreasonable procurement contracts and questionable investments. Look closely at the buildup of massive intercompany receivables held inside profitable subsidiaries. Instead of sweeping cash up to the parent entity for dividend utilization, the capital is locked inside peer subsidiary lending loops to avoid triggering a group-wide liquidity event. Alarmingly, by the time public distress becomes obvious, the high-level management and board members responsible for these structural failures have often already quietly left the company. Identifying these deep, hidden stressors early is the difference between controlled structural restructuring and sudden corporate collapse. It is a governance framework that warrants ongoing, objective evaluation. For deeper breakdowns on corporate governance and strategic restructuring, let's connect on LinkedIn.